Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our last econ show of the year, and I feel like it's ending the same way it kind of started when we looked at some of the data coming into this year. But I think people have now fallen closer to where we are on the spectrum of economic growth and expansion, or lack of expansion rather, and really what that means for the next year. And we've said before, we think Q1 is going to be a bit of a problem. Q2 should have a nice bounce within it, and then we think Q3 and Q4 again become a bigger problem. And that's going to lead to some additional issues when you look at jobs, when you look at employment, when you look at wages and all these other pieces. But we want to look at those, piece by piece over this current episode and the following segments, because I think it's important to understand where are we right now, where are we going as we head into next year, and why more of a stagflationary backdrop makes sense until we get to closer to Q4 of next year. So first, we're going to kick off with just a quick outlook for how the outlook for 2023 falls further, and this is just coming from other people that are starting to come into some of the understanding. We're going to look briefly at Russia, Ukraine, and some of the advancements that Russia has made in some areas, and where Ukraine has been able to hold some locations. Then we're going to look how sticky inflation got worse again, and how that leads more to a stagflationary backdrop, and then the data sets that are showing how a stagflation backdrop is really setting in as we head into Q1 and Q2 of next year. And then we're going to look at following U.S. data points, which point to a very weak Q1 of next year, looking at leading indicators, housing data, why that is going to continue to be a problem into the beginning of next year. Then we're going to look at European data. So the data is stabilizing. And for those that have been watching us, we said that the data was going to get worse. And again, it was going to get to a point of contraction, but then it was just going to kind of hang out there. Like, we didn't see this going and nosediving, but it was going to get bad, and then it was just going to kind of flatline. And that's where we are at this point, where now we're just kind of bumping sideways as things continue to be in a contractionary backdrop. And then we're going to look at how the Chinese data has worsened considerably as the COVID spike has come to pass, as we've been saying. And then the question is going to be, when does that COVID spike fade? And then what does that mean for underlying activity as we go forward? So now kicking up with the different levels of Ukraine. Here you can see, when you look at the different areas of control as of December 20th, you can see that largely speaking, very little has changed when you look at the grand scheme of things, holistically. But then when you zoom in, you can see that there have been some advancements by Russia in some now very contested areas. So when you look at around the Donetsk, you can see that there has been some movement forward, which is the dotted line, which is now essentially the line of engagement has moved forward. There has been some movements, but right now, and you can kind of see it, where the area that has been gained is kind of no man's land, and then you're seeing it stop right at a lot of the cities where that's where the Ukrainian military is putting up their fight. So far, they have rebuffed most of the attacks so far coming into the cities, but you can see that there is still some contested areas as you move further south on the Donetsk Oblast. You can see that further north, there has been some additional advancement, where Russia and Ukraine reports about Debrova's status contradict each other. And so far, when you look at that region, there's one city that was retained by Ukraine, but there are some other areas that Russia has moved in on. But you can see that there has been a counterattack from the Ukraine since then, which again keeps things questionable. And then when you look at Kharkiv and that area around it, that's when you can see some of the movements that have been solidified by Russia, while by Lyman, essentially Lyman, if you think about heading west to east, that has been more contested because that is where there has been a launch of the Ukrainian counterattack. So for those that have seen, the Ukraine President Zelensky is currently spoke to U.S. Congress. He's asking for more support. The U.S. is sending Patriot missiles and a battery of Patriot missiles to Ukraine, more for they can be used offensively, but also for defensive in terms of anti-aircraft, anti-missile. So there is a lot that is happening, and the current backdrop remains very fluid when you look at this, and we expect to see more of these back and forth as we head into the new year. Now, when we turn over to the economic front, you're going to see the majority of emerging market central banks are going to tighten further in 2023. That is consistent with everything that we've been saying. We don't see any pivot in the near term. And you can look at, Goldman Sachs is saying that they expect some rate cuts into Q3, Q4. I think that's going to be difficult. And the reason why I say that is purely along the lines of inflation. When you look at the inflationary backdrop, there is a lot of stickiness when you look at even emerging markets, which is why we think there's going to be a lot of pressure. You can make an argument that they might run a little too hard in Q1 and Q2, and any cut is going to be smaller. And it's just trying to essentially overreach to the upside and then gradually cut on the downside. That is feasible. It's not a base case for us. If anything, we think that they're going to try to get to those levels and then hold. You've already seen how Japan has panicked. You've already seen the BOJ shift, which is why that's a big indicator for where is the dollar going. The dollar strengthened again today. We think the dollar is going to go up a little bit, by no means back to where it was, but there is a lot of staying power here, which is why I think there is a lot of some movement where emerging markets are going to continue to struggle, because really that's the last shoe to drop. And then even when a recession is expected, I thought this was a good one. Forecasters tend to underestimate the severity. And that's always the case. Typically, economies, crude, pricing, they overshoot to the upside and downside. And I think that's going to be the case as well, where the recession is going to be a bit worse than expected. And I think the impact on emerging markets is going to be really exponentially worse even than what the market is expecting. Because when you look at IMF, when you look at some of these views, global growth is actually still positive in some of these estimates in 2023. And that's just not something that is our base case. Not to say that we expect the world economy to go down 10%, but to see it slow down 1%, it would not be a surprise in the slightest, especially given, the reverberating pieces of that bullwhip. And I think people like to say the term bullwhip, but there's not you have to think about where the bullwhip ends, and it ends at the emerging markets. And you saw it with Micron, with a massive increase in inventories. I think you're going to start to see that with a lot of inventory builds, a lot of this overhang, which is going to put more pressure on these economies. And I think a lot of these uncertainties and these rising rates and I think it's interesting to look at the aggregate negative yielding debt has gone from 16 trillion upwards to 18 trillion in January of 2021 to just on over 1 trillion. So you've seen a swing of almost $17 trillion of negative yielding debt to positive yielding debt. And that is not real rates. That is just nominal rates. Because when you look at real rates, and which is just taking the rate that's there minus inflation, you're still negative. So it just gives you an idea of where some of those disconnects are. And then household debt to disposable income. It's interesting when you look at where things are today, they have improved since 2008 for some countries, but you're still at 100% or more of household debt to disposable income. And that's when you start looking at some of these pieces, Canada, Australia, New Zealand, and then you come down to the UK, then another layer to Eurozone, United States. You're not seeing a lot of buying power at this point because the U.S. hasn't really gone up or down. Everyone likes to make a big noise about savings, and there hasn't been a huge shift. If anything, and there's a bigger problem where you have a huge shift higher in credit card debt. You have had some savings, you have had some increases in wages, but they haven't kept up. And that's why we do think that there is a lot of downside. But this is looking at global spending, because these are the key areas that are going to be buying. And this is our way of showing that, look, buying is not going to be all that great with inflation where it is, with the fact that debt's going up, debt's now getting more expensive. Because realistically, in 2008 to now, debt was cheap. And now the cheapness is changing as rates continue to go up, which is going to put more pressure to the downside. Now, when you look at prime age population, this is something that we've been talking about on the demographic side, especially when you look at the talk of a depression or something more severe. The demographics make it difficult, because if you think about when the U.S. had a depression in the 30s, we had the potato blight, we had the famines in Europe, we had a world war. And when you look at Ellis Island, you had ship upon ship of people just pouring into the East Coast. You had the hope of a new life. You had a lot of building. You had this huge resurgence. And then the rug got pulled, and you had all of these people that were still coming into the United States up until the mid 30s, which again, you don't have that right now. So that prime age population, and the prime age is key because, and I think we have a chart here, or we showed it last week. There's a huge gap because all the baby boomers are now retiring. So when you look at the available people to work, that's all declining, and the biggest drop, which is the most aggressive, is China, where those numbers are getting aggressively worse, and all of this makes it very difficult. So then when you look at countries to experience a recession in 2023, you get an idea of the percent of global economic output that is going to hit. And as that comes through, all of these are key buyers back to the same one. So not only are we going to have a recession at this point, but then when you look out at production, when you look out at jobs, there's a lot of headwinds coming. That is why we've been so concerned about this whole decade, because a lot of the issues that we've seen are accelerating at a bigger clip as we head into 2023. And that's something that, again, changing the demographics of a country, let alone the world, is not a small task, because there is a gestation period. There is, the baby, toddler, infant, all these different years before you get to prime age. So there's a lot of hiccups that we see and problems as we go through the remainder of next year. And then when you look at the demand conditions, there's still a drag on for some of the commodities, but demand can drop, but supply is not rising either. So that's why when you look at, global manufacturing PMI now in contraction, real commodity price index will be pulled down, but it's not going to be pulled down in the same way, because we still have shortages in the ag world. So ag still has some pricing power. You still have pricing power in natural gas and some of the other refined products, i.e., ultra low sulfur and low sulfur diesel. But not to say it's not going to come down, because it will. It's just not going to come down to the level it should, given the depth of the depth of the demand destruction that we're going to see, because supply isn't really there either, especially when you look at copper, nickel, lithium, because a lot of the countries that this originated in, they're trying to clean up their environment. They're going after mining, and you're not going to see this huge response, which again is going to keep some of that and support some of our views on the stagflationary front. So then when you look at the global sales manager index, it is now in contraction, business conditions deteriorating, market growth negative, sales growth coming down, prices charged coming down, still positive, but coming down. Staffing levels flatlining at this contractionary level, with profit margins showing a lot of that pressure. And those are things that we see propagating and, again, getting a bit worse when you're looking at sales, business confidence, and more importantly, market growth. Because market growth is what we've been seeing slow. And when you look at sales manager index, a lot of that is going to follow the market growth side. which remains a problem. Then wrapping it up, when you look at Germany's gas consumption, it's going higher. And it's not surprising because when you look at 21 into 22 and 20 into 21, there's a little thing called winter, and winter comes and people consume more natural gas. So that's when you look at gas consumption. The view is they've managed well to this point, but as we've shown in previous episodes, that goes away because then the next 6 months becomes very difficult. And it's interesting when you look at that slow transition. About 30% of G20 electricity is generated from renewables, but look at how difficult that shift has been. And it's not like it's going to get a steep drop off just because you still need fossil fuel backup even as you increase, because wind, solar, hydro, that can ebb and flow. And as that ebbs, you need fossil fuels to back up a lot of that capacity, which is why that transition still remains very slow, and our reliance on fossil fuels will be there, as you can see, especially with Germany at this point. So that's what we have for you on the global side. In the next segment, we're going to go deeper into the US and some of the issues that we have heading into next year.